Hello, Dr. Gamble here with a presentation from the block Hirt, Danielsen, edition 14, text of Foundations of Financial Management. And what I would like to do today with this presentation is to just hit the key points from this particular chapter. So when we look at chapter 1, the goals for this chapter basically outlined the format of the text, how the textbook flows, and then within each chapter, as in chapter 1, the primary learning objectives, and then key terms. And since this is a foundations course, one of the primary objectives of a foundations course is to increase your vocabulary, your business vocabulary. So when we look at the format of this particular textbook, it's broken into six sections. First section is the introduction. The second section looks at financial analysis and planning. The third section looks at working capital management. The fourth section looks at how to maintain your capital budget process. Your fifth section looks at the various long-term financing strategies a company might use. And then the last section looks at the perspective of corporate finance and helping you to expand your understanding. So in chapter 1, the primary learning objectives revolved around 5 areas. One was to increase your financial vocabulary. The second learning objective is to help you integrate concepts that you've learned from other courses, such as economics, accounting, and other business courses like organizational behavior and human resource management. You can also incorporate some of your liberal arts courses, such as psychology and sociology. Another primary learning objective within this chapter is the various types of business forms a business might take, such as a sole proprietorship or corporation. The fourth learning objective looks at the maximization of shareholder wealth. And shareholder wealth is primarily attained through the owning of common stock. But we'll look at the capital structure and actually see that there's 2 methods of how a company attains finance to pursue the ventures that it seeks. And then the last learning objective, we'll look at how financial managers try to maximize shareholder wealth. And this falls into what is known as agency theory. So to review the chapter, I'm going to, here's a list of all of the vocabulary that was introduced in this chapter that might be new to you. However, I'm just going to isolate on a few of these definitions to give you a little deeper explanation to help build your understanding. So financial markets. When people refer to financial markets, they're typically referring to what is known as Wall Street. Wall Street is a street in downtown New York on the island of Manhattan, and it's considered the financial hub of the world. Wall Street is the center of finance in the US, and as I said before, could be argued the center of finance for the world. Now, these financial markets fall into various categories, and we'll drill down into that on a later slide. Real capital. When you're looking at a company, it has real capital, right? So you have capital, which is typically referred to as money, but then real capital a company might have is you might have heard the acronym PP&E, plant, property, and equipment. So a company would own equipment inside of a plant, i.e. a factory, The equipment would be the sewing machine. Also, the equipment would be the truck, or if they own ships, right, that would be equipment. The plant would be the factory in which this worker is actually working in. And also some of the other real capital is the inventory, the value-added inventory that these workers are producing. And then property, PP&E, the owning of buildings. So PP&E, plant, property, and equipment, fall into real capital. So, given the introduction, I touched on this concept of capital structure theory, or capital structure, right? So when you look at capital structure, there's two major categories: equity and debt. And in this example, I'm just using a pie chart to illustrate the two. A company does not necessarily have to use 50% equity and 50% debt to fund its business. So if we drill down into these two sections, what you find is there are basically three major areas of debt with counterbalances. So secured debt, and the counterbalance to secured debt is unsecured debt. So that's one form of debt. Then debt can be private or public. And debt can be syndicated or bilateral. Most people are familiar with the bilateral debt. That's when a lender lends to a borrower. A syndicated debt would be a group of lenders lending to a single borrower. And then lastly, you can have any combination of these forms. So for example, you can have secured public debt that's bilateral, or you can have unsecured private debt that's syndicated. Now when you look at equity, there are three major forms of equity. Most people have heard of common stock. That's the stock that gives people voting rights to control the board of directors and steer the company in the manner that the majority of stockholders want the company to move in the direction they want the company to move in. But there's also preferred stock. Now preferred stock can get quite complicated. However, when you just look at preferred stock, right, the primary design of preferred stock is to pay the preferred stockholder a dividend, and this dividend is paid typically quarterly or semi-annually, and this dividend can be either cumulative or non-cumulative, meaning if a company chooses not to pay the dividend one quarter and it happens to be a cumulative preferred stock, when they do pay the dividend out in the future, they would have to pay all of the dividends prior to the current dividend along with the current dividend. Common stock, that's the stock that controls the company, has voting rights. Preferred stock does not have voting rights. Sometimes you can have preferred stock that can convert into common stock, given the common stock hits a certain price. And then lastly, stock warrants. Well, stock warrants are basically someone giving money, or some entity giving money to a company in the hopes that the common stock price will rise to a certain point where they will now have the opportunity to purchase that stock at the previous stock price. All right, so the reason you would do this is you see growth in the company, the stock is going to go up, the money that is being given to the company will be less than the price of the new stock price in the future, therefore producing a profit. This other concept that I wanted to make certain you understood, inflation and deflation. So there's actually three aspects to it: inflation, disinflation, and deflation. So inflation easily put, is the growth in price. And you see how that slope of the arrow is high, where disinflation is the slowing of the growth in price of objects, and then deflation is the decrease. And you can see that slope down is a whole lot steeper than disinflation. Right, so disinflation could be slowing the price growth up or down, but deflation is absolutely the decrease in price, and inflation is the increase in price. Now, partnerships, right? So credit default swaps. A credit default swap is a contract that secures some type of security, investment instrument. It's just another way of providing insurance for the person or the entity lending money. So for instance, if a company were to buy some new factory equipment and they borrow money, and it's hundreds of millions of dollars worth of equipment, the lender might go seek credit default swap, meaning if the company can't use the equipment properly and produce enough income, this credit default swap may be based upon some other indices, some other securities outside of the company's control, which would trigger some type of payment to the lender. And that borrower, that lender, would actually pay some other entity for that type of insurance. Now, a partnership, so this falls into the corporate structuring, right? So a business type comparison. And I'm gonna pause on this because what I want you to do is just take a look at these 4 categories, and there's also one more category, a sole proprietorship, and I'll just tell you what 3 areas the sole proprietorship maps in relation to a C Corp, an S Corp, an LLC, and a general partnership. Now, a C Corp is a for-profit taxable corporation. It could also be a non-profit as granted by the IRS as a 501c3 charitable organization. A C Corp has these type of benefits or associations attached to it, where an S Corp is a corporation also, but you see it doesn't receive all of the considerations that a C Corp actually attains. And then an LLC, a limited liability corporation, looks a lot like a C corporation. However, it doesn't have 2 characteristics that a C Corp has, but it has one characteristic that the C Corp does not have. And then lastly, the general partnership, right, have these characteristics. Now, I will finish this conversation on the business type comparison on part 2 of this presentation.